Hi, this is Dan Collins, coming to you live from Traders Expo Chicago. Joining me is Bill Baruch from Blue Line Futures. Good to have you here.
Thank you.
You know, Bill and I were just talking about all the different reports that he puts out, and we're really, the middle 2019 is a really key point for a lot of different markets, and we want to talk about what's going on in interest rates right now that's very interesting. Bill, what are you seeing?
Well, I think one of the most ironic things out there is the interest rates, the treasuries have already rallied, and that means the yields are already very, very low. And it's been a big theme of ours actually to be bullish treasuries since the turn into 2017, but nothing moves really in a straight line. It took a little time to bottom last year, but it's been straight up much of this year. And I think you're already seeing them price in these interest rate cuts from the Fed. So if you look back to QE1, QE2, and QE3, you saw the Treasury futures rally into those each time. And then as soon as they announced the QE1, QE2, QE3, we started to sell off. I think we're seeing a buy the rumor, sell the fact sort of thing here right now. It's already priced in, and one of the best trades over the next 60 days really could end up being short treasuries or have put exposure in treasuries.
Yeah, you left out Operation Twist. I can't remember what exactly, if that was a peak too, but that was, I guess, QE 2.5, or
yeah.
That was between 2 and 3. Speaking of treasuries, I mean, we had been talking for years and years, is this long bull market in treasuries over? Most people believe it was, but we're getting into a level that, is it? Where we...
I never believed the bull market was over. In fact, it turned out to be one of our best trades last year, but it was not easy. We had to stick through it and grind it out when the treasuries finally turned in October. But I think the rates are lower for longer, and this is going to be the pullback that you can really capitalize on. But if you take a step back and look at the Fed interest rates going back to 1980, it's a trend down, and every peak has been a lower peak. So you look around the world, and sovereign debt is at zero or in negative territory, and that's supportive to gold. That's why I love gold. But at the same time, I think we're going to move lower for longer. The interesting thing here in this very intermediate term is you're starting to see U.S. data get a little bit better than the expectations. Manufacturing payrolls in the early part of July for the June number, and then the CPI was stronger. We've seen retail sales better. So the data is getting a little better, and it typically comes at this time of year. We're about a month, I think, behind because of the government shutdown, so it's pushed us back. So the data is a little better, but we've also already priced in the interest rate cut. So I think right now is that time. If you ever wanted to fade the bull market, which I still call bull market treasuries, this is the time to do it.
Well, and it has a big effect on Forex markets, and it just, what you're saying made me wonder, we went through recessions before where 3.5% was the bottom of the Fed, the absolute bottom of the Fed funds rate. Now we're in this, finally, this tightening cycle after 7 years of zero interest rates, and we're calling for more easing. The top of this cycle is between 2.25% and 2.5%.
Yeah.
What effect does that have on the broad equity markets and Forex markets that, we're in such a different world?
Well, going with the Forex markets first, the dollar, when you look at the dollar index, which is 70% the euro roughly, you're going to see you have a nice wedge pattern that's building right now, and it's waiting to move. And on top of that, you're seeing a lot of the volatility slip out of some of the currencies. There's some day-to-day swings, but broadly speaking, the euro has been tethered down to 112, and we're waiting to see where things move. And it really comes after we hike here, after we cut. What does the data do? And I think going back to the interest rate part of it, if they're preemptive, they're just walking back that December hike and ultimately canceling that out, but as well becoming just really definitive and trying to preemptively fight any recession fears, take back that hike as well as cut an extra, and they're talking about 50 basis points at some point here, and Thursday and Friday was up to 70% probability. That's come back. I don't think we see 50 basis points, but I can certainly see them make the argument for 50 basis points, considering that they want to be preemptive and considering they want to walk back that December hike. So ultimately, we could see 50 basis points, and that's where the markets would get surprised.
Okay, and it might have been in your report or somebody else's, but I saw the argument that the reason some people are considering a 50 basis point cut would be not very dovish, but the fact that this is a one-time event, and that's not. They're half the world is really thinking that we're moving into an easing cycle, and the Fed never really committed to that. They may have acknowledged that they may have gone one step too far, but we're still in this theory that it's a timeout. I mean, that was a timeout, 2.25, like I said earlier, is not supposed to be a top of anything.
Yeah.
So do you see that as trying to cause the timeout and make a dramatic move with 50 basis point, thinking that we're going to rejoin a tightening cycle with better economic growth in the future, or the beginning of a longer term easing cycle?
I think it's more likely that we see them quiet down for a bit. We could get 50 basis points. It's looking back historically, the Fed cuts, they do it definitive. That's why it's also potentially being priced in if they jump in there and do that. But if they do 25, or 50, they're going to potentially bubble wrap this with a less dovish rhetoric. And that's one of the reasons why I do like fading the moving treasuries. They're going to, same way when they were gradually hiking, the days that they hiked on those meetings, they would bubble wrap that with a less hawkish rhetoric. I think they do the same thing, but opposite here.
Yeah, well, the hawkish rhetoric, remember what people made the point that they were unwinding all their liquidity, all the purchases that they had made over the years. So that was like double tightening cycle, because they raised interest rates and they were buying back some of the treasuries. We're at a very low level here. If the economy slows or continues to slow, there's not much way to go. Is there a QE4 on the horizon?
Well, here's the thing: is when they were hiking, they said they were doing this so we can jump in and cut, and that's what they're doing here right now. That argument right there gives them the firepower to do this cut. And I think you're going to see the data respond. I think you're going to see growth respond. But the other question is the trade war. Does the trade war linger out? It doesn't seem like there is a light at the end of the tunnel. Some days there may be a dim light, but ultimately, if the trade war drags out, it's going to weigh on the global growth, and that is the factor that the U.S. is looking, or the Fed's looking at. Not just the U.S. growth here, but the global growth, and that's why they don't want it to trickle in, and they're trying to jump in front of it.
So it looks like we're back onto the risk-on, risk-off economy.
Yep.
Well, for you to learn more about this, you can go to bluelinefutures.com. Bill Baruch, you'll see his commentary on MoneyShow.com. I don't recall a period where it's more important to it. So it's good information and really necessary in a very volatile area.
Thank you for having me on.
Bill, thanks for being here. This has been Dan Collins with Bill Baruch from bluelinefutures.com, live from Traders Expo Chicago.